Okay, good afternoon, and thank you for joining us for a timely capital markets update. I'm Barry Mandenack, Executive Vice President and Head of Distribution at Virtus Investment Partners. I'm fortunate to be joined today by Virtus's Chief Market Strategist, Joe Terranova. Joe's going to spend a few minutes sharing his insights on recent market events and volatility before opening up the discussion to our three featured panelists. I'm pleased to welcome on today's discussion three of our managers at Virtus affiliates. Dave Albright, President and Chief Executive Officer of New Fleet Asset Management, Roy Barron, Co-President and Co-Chief Investment Officer, Westchester Capital Management, and Young Kim, Portfolio Manager and Senior Research Analyst at Kayne Anderson Rudnick. Welcome, and thank you all for joining us today. Before I turn the discussion over to Joe, I'd like to remind our audience members that we invite them to ask questions at any time throughout the webinar. To ask a question, please type it into the Q&A section at the bottom of the screen. And with that, I'll turn it over to my friend Joe.
Barry, thank you for that wonderful introduction. Great to see you. And to all of you who are joining the call this afternoon, thank you so much for doing so, taking time out of your busy schedule. I hope you and your family are enjoying the beautiful summer weather. Now, it might feel like markets are entering the summer doldrums, but let's remember something. The market never makes reservations with us in terms of what our summer plans might be. The market continues to move forward, continues to march forward. And in that regard, as we speak today, S&P 500 records another intraday all-time high. The same can be said for the NASDAQ 100 and certainly for the NASDAQ Composite as well. Very interesting because at the end of June, I put out on Virtus.com an extensive video talking about the first half of 2025 and reflecting and preparing for that video. What was interesting to me is that the conditions, the fundamental conditions that set the foundation for the secular bull market we entered 2025 with, not very much had changed in those conditions from the beginning of the year through the middle of the year. What we did experience was significant elevated volatility, in particular in the early days of March. You had the VIX, which spiked up to 30, and then certainly in the early days of April, when we saw volatility as represented by the VIX spike up to 70. But thereafter, the fundamentals kind of took hold once again. The fundamentals which have supported the secular bull market that have been all about a Federal Reserve that wants to continue to lower monetary policy out of restrictive territory. I know we see this constant friction between President Trump and the Federal Reserve and Chairman Jay Powell. It's really about timing of the next rate cut. It's not so much about the fact of the direction of monetary policy. They cut in the fall, and I believe, my perspective is they're going to begin to cut once again in September because the eco data is presenting itself accordingly in a fashion that would suggest they can cut once again. You have the disinflationary trend remaining in place, stronger in Europe than here. One of the reasons why Europe is outperforming. Earnings growth is present. We're working on 8 consecutive quarters of earnings growth, profit margin expansion, and the innovation. Well, the innovation is certainly real. I think it's represented most by the recent price action in the semiconductor industry. Many of you heard me in the past talk about how the semiconductor industry today is literally what the energy industry used to be 30 and 40 years ago. It's the mobility of the economy. It's how we move forward our economy. And they are so critically important, and recently they're all experiencing very strong price action because the capital spending on the industry is very intense. But as I said before, not very much has changed. And if not very much has changed, then the pricing of risk assets very quickly recalibrates back to the starting point. I believe that's what's happened. Our expectations surrounding tariff rates have returned to the consensus levels earlier in the year, not the unsustainable levels, talking about a Chinese tariff rate of 145%, but it's returned to the comforting levels of where we were at the beginning of the year. In terms of volatility, that has returned to where were rather at the beginning of the year. We got a 16 for VIX. Taxable fixed income markets trading relatively well so far year to date. Look forward to talking to Dave Albright about that. What's interesting is when we last spoke on April 22nd, 10-year Treasury was pricing at 4.40. Dave can correct me if I'm wrong, but I think a 10-year Treasury went out today trading at 4.37. And we finally have a market that is representing price performance beyond the Magnificent Seven. And you want to talk about the resiliency of this current marketplace. If at the beginning of the year I were to tell you you'll have Tesla down 19%, Apple down 14%, Alphabet unchanged, Amazon only up about 4%, we'd overcome some geopolitical tensions in the Middle East, Israel, Iran, and the United States, elevated volatility, I think you'd find it stunning to know that we'd be sitting here today 1,000 points higher at 6,200 relative to where we were at 5,200 back on April 27. So that speaks to the resiliency. It speaks to the V-shaped recovery. It speaks to the skeptical nature, and it speaks to the fact that the market doesn't wait for us to enjoy our summer holiday and make the return and start investing once again. There's opportunities in the marketplace. It's about alpha generation. I've said that since the beginning of the year. Not about chasing beta. It's not about the Mag 7. It's about opportunities that go beyond the Mag 7. It's about opportunities that for the first time go outside the United States, into Europe, opportunities that go into different equity size classes, and lastly, opportunities that still find the value, once again, in taxable fixed income. So that's where I'd like to begin the conversation, inviting in my good friend, Dave Albright, to talk a little bit about the opportunity. And Dave, I think it's rather compelling to see, as you and I have discussed in recent weeks, how the value has been restored once again in taxable fixed income. If you could just kind of guide us through how you've come to that very strong conclusion.
Sure, Joe. I always love to say it, the value's been restored to fixed income. If you look at discount dollar prices and all-in yields, one of the best determining factor for forward-looking returns is going to be starting yields, and they're very, very attractive. Insurance companies, pension funds, and institutional accounts, when corporate bonds are yielding over 5%, they get very excited. If I look at some of the other things out there, tariffs. Obviously, you mentioned influx, a lot of uncertainty. We really haven't seen it in the data yet. For us, it will be, what will the impact on growth and inflation be looking forward? In the fixed income market, I would say spreads are pretty much fair to tight. Inflation trending down, but still higher than target. The economy strong and no recession. Rates, 10-year is between 4 and 5%. As you stated, Joe, it's actually 4.38 is where it ended today. So rates are range bound, and the Fed looks like 2 rate cuts in 25, possibly 3 in 26. That's going to be heavily data dependent. Bottom line, bonds definitely are attractive. It's a great diversifier, and you have potential for total return with discount dollar prices.
Dave, when you look at balance sheets, would you agree that corporate and consumer balance sheets are in a much stronger position than governmental balance sheets? And unfortunately, a lot of investors make the mistake of assigning a particular bias overall on fixed income because we keep hearing in the headlines and seeing it reflected certainly in the actual statistics that governmental balance sheets, the quality of them right now does not look so strong.
So if you look at corporations, most have delevered. Leverage is definitely down. Earnings have been relatively strong. Most debt maturities have been pushed out if you look at leverage finance. But you're exactly right, Joe. I mean, if you look at the U.S., you have debt to GDP at 123%. It's a little scary, something that needs to be taken a hard look at. But compare that to some of our peers in the EU. Italy at 137, I believe. Greece is about 142, and the perennial outlier of Japan at 235%. Interest on our debt is $1 trillion, which is more than we spend on the defense budget of, I believe it's around $895 billion, which is a little scary, but we're still the reserve currency. And I think it becomes a much bigger issue if the market becomes concerned, but we really haven't seen that as of recent. There's been some scares in We've heard something about France, we've heard the UK very recently, then again about Japan.
And that's a backup in the long end of the curve. Dave, just real quickly, if you could, how focused are you? And I guess I would ask, are you somewhat surprised on the fact that this constant conversation about the removal of Federal Reserve Chairman Jay Powell has really undeterred a very strong risk asset price appreciation?
Yeah, I would say, with Powell's removal, it's possible, but not probable. I believe his term as Fed chairman is through May of 26. He's one of 12 voting members, right? You have the 7 board of governors. I believe you have the New York Fed president. You have 4 other rotating regional vice presidents. Most are saying what we believe, policy is good, and they're going to be patient. He was removed with cause. He did have, modest expenditures. I believe it was $2.5 billion on fixing the Fed. But if he was removed from office, that would create some volatility, which would probably create an opportunity for us to get invested, buying on dips.
Yeah, my quick response to that would be the congressional testimony of several weeks ago. I thought he really gave strong guidance on what he was looking for as it relates to inflation. He said in the June and July inflation reports that will be reported in July and August, I expect to see the inflation show up. It did not really materialize the way that he described it in the most recent report. We'll see what happens in August, but after that, he might be out of time and therefore forced into cutting rates in September. Young, I want to thank you for your patience. Great to see you on this quarterly call. I hope we see more of you in the future because you educate all of us. I mentioned at the top that there's the opportunity once again outside of the United States. And I think the way I would describe it is if you reflect on sentiment and positioning as it relates to non-US equity markets over, let's call it the last 5 to 7 years, I think it's fair to categorize each of those as maintaining a bearish sentiment that was reflected in an underweight strategy. Describe to us why there seems to be this paradigm shift in 2025, where at a minimum, it's time to elevate that perspective surrounding sentiment and positioning.
Yeah, so obviously non-US equities have underperformed the US for many years. But this year so far, it's been outperforming. And the question that many people are asking is this sustainable? The non-US equities outperforming? And I think my short answer is yes, that's very possible. We obviously cannot predict what the markets will do in the near term. But what we can do is look at fundamentals. And fundamentals still look very favorable for international and emerging market equities. Even though non-US equities have gone up in value this year, valuations still look much more attractive compared to valuations in the US, especially now that the US markets have had a rally in the second quarter. If you look at this chart, you can see how much of a discount non-US equities are currently trading vis-a-vis the S&P 500. The gray bar here shows the 20-year average, and you can see that non-US equities overall has historically on average traded at around 18% discount. But today that discount is at 35%. And it's not just a valuation argument anymore. Europe is having a bit of a moment of reckoning, I would say, and is putting in place measures to boost its spending, especially around defense and infrastructure. And many emerging market countries are expected to grow their economy at a faster pace than the US. In addition, we have to remember that while US has outperformed non-US equities in the past, say, 10, 15 years, if you go back farther in history, there have been many periods in which non-US markets outperformed the US. The decades of 2000, the 1980s, the 1970s would be examples of that. And these trends typically last more than just a couple of quarters. And let me give you one more data point. In the last 15 years, trillions of dollars flowed into the US. If you look at net investment position, which measures the difference between US-owned foreign assets and foreign-owned US assets, this number was around minus $2.5 trillion 15 years ago, meaning that foreigners invested more in US assets than US did in foreign assets to the tune of $2.5 trillion. Now, fast forward today, that number grew dramatically over the past 15 years, and today it's at around minus $25 trillion. So it's up tenfold. So while some of it was driven by the rise in US value, US asset value, a big chunk of it was driven by the inflow of trillions of dollars into the US. And you could argue that the inflow caused the value of US assets to rise to some extent. And investors around the world ended up with a huge overweight position in the US. If you pull up the chart 4, you can see here, this is an illustration of how the share of global market cap of countries have evolved over time. And currently, US is as high as it's ever been, over 60%, up from 30%. And this goes back to 87. But the number one spot is never guaranteed. If you look at Japan, in the 80s, it was over 40%, and today it's only around 5%. And although US is expected to remain a large and liquid market, its share of the global market is expected to normalize or at least grow at a slower pace, given the very high valuation, tariffs, and other policy-related uncertainties. And we are already seeing it this year, so it is essential to keep in mind that new trends and themes influencing growth and earnings can always arise, which can lead to a reshuffling of the global leaderboard.
So Young, let me respond by asking a question. And while I do that, if we could put that chart back up again, please, I'd appreciate that. But I think for all the attendees on the call, the thing that you think about when you look at this chart and you see the exponential growth of US weighting really beginning in the late 90s and the deceleration, certainly for Europe, simultaneously at that point, how much of that is attributable to the very composition of what the US is, right? If I think about the US equity market, what comes to mind? Apple, Microsoft, more recently, NVIDIA. I look overseas, maybe I don't get that type of technological composition. And in a certain sense, given where we are, where concentration is becoming a challenge over the last several years, would that not be another added benefit moving outside of the US and looking for these opportunities in non-US areas that maybe can offer more of a diversified sector composition relative to what we have here in the US?
Absolutely, I would agree with that. There's no denying that US has had a very strong economy, has had many great companies. Earnings growth was very strong in the US. So there's no denying in that, and that's been a big driver of US outperformance. But what's been another meaningful driver of US outperformance has been multiple re-rating. So that's also something that investors should keep in mind. And as you mentioned, a lot of the outperformance in the US was driven by these high quality large tech companies. And if you look at other areas of the US markets, the small cap, for example, even have really not outperformed non-US markets that dramatically. So I think given the concentration, and given the valuation, especially around those big tech companies, I think it's prudent to have some diversification away from the US.
Thank you. I appreciate that. Roy, good afternoon.
Good afternoon, Joe. Thanks for hosting.
Great to see you once again. Let's just begin with the basic. And by the way, I was on CNBC last week, and we were talking about financial earnings, a lot of the money center banks, and there's some really strong investment banking revenue that's being reported. And what you're beginning to see is that in the month of May, there seemed to be this, this is what we have been waiting for as it related to advisory fees and some uptick in M&A activity. You're finally seeing it. So we're talking about a strategy that has budding optimism in front of it that we've been sitting and waiting for literally for the last 4 years and 3 months. Walk us through exactly, if you could, merger arbitrage. What is the differentiation about the strategy relative to my thinking of, okay, I'm going to invest in stocks, I'm going to invest in bonds?
Well, you're right about the pickup in activity. That's for sure, and we can talk about that a little more. But
Well,
just to give you a brief overview, merger arbitrage is a strategy that involves investing in the shares of companies that are involved in mergers and acquisitions and other types of corporate reorganizations, with the goal of profiting from the successful completion of the transaction. It doesn't involve making a bet that a company is going to do well in a consolidating environment, or picking the shares of companies because you expect them to be taken over. It used to be called risk arbitrage, given, in the old days of the swashbuckling investors of Carl Icahn and the proprietary desks of the brokerage firms. But it kind of gave a wrong impression of the strategy, because the risk that we're taking is not market risk. It's the risk that the transaction will be successfully completed or not. So we'll make an investment in these transactions after the deal is announced, with the goal of profiting when the deal is completed. Because typically, after a transaction is announced, the target company will trade at a discount to the value of the deal. Because of the time value of money, you have to wait until the deal closes. Because of potential uncertainty that the deal may or may not close, they need regulatory approvals. There may be some delays. There may be some shareholders that are against it. So it's actually, the reason why it's called merger arbitrage is because it's a fairer and more complete view of the strategy itself. We have a diversified portfolio of investments. We have a diversified portfolio of transactions, the vast majority of them which close. And so it tends to be uncorrelated with the stock market in general. The risk that we're taking is not equity exposure. It's not directional exposure to interest rates or the indexes itself. The risk that we're taking is on any individual deal, whether or not it will be successfully completed or not. And so if we own a diversified portfolio of those, it reduces the risk even further. And that's why we have a very, very low correlation with the stock market and the bond market. I mean, the correlation with the bond market is around 0.1 or so. Correlation with the equity markets is a sub 0.2. So it acts as a diversifying strategy to those other investments that would otherwise leave people exposed to the vagaries of market movements up or down.
all right, so you have this moment, which I would identify as maybe an awakening, where the opportunity as it relates to the environment for the strategy you're describing becomes fruitful once again. I applaud you and the team. And by the way, how many years have you and the team been implementing this strategy?
Oh, we've been doing this since the 1990s. We've
Okay.
invested in thousands of transactions.
And I applaud you for staying anchored to it, because over the last 4 years, I've heard several people who have done what you have done over the past several decades say, we're pivoting away. We're going away from that strategy. We're looking towards another strategy. And I ask you that question because I kind of wonder now, as we reach this moment that potentially you have an awakening for the strategy, and people try and, as they usually do, chase the performance and make a return to ownership. Does that put you in a more favorable position because you've sat there through what was a little bit of a difficult period over the last 4 years while others have gone away?
I think so. I mean, we've seen a change in the environment. We've seen under the Biden administration, the regulators were very activist. They were very academic in nature. They had philosophies they wanted to impose on companies. And now under the new administration, companies are seeing that it's much more transactional, much more open to growth and facilitating growth. And we've seen deal activity basically double from 2023 to the current year run rate. So I think it's a good environment for both approvals as well as for deal activity. And you see bankers ramping up their deals team. You see lots. We've seen billions and billions of activity. We have, you see oil and gas companies merging. We just had a great ruling in the Exxon Hess transaction. There's the financial industry is consolidating, and so it's a very good environment. And again, it provides a diversification to a market that is basically trading at, we're hitting all-time highs. The PE ratio of the S&P is, what is we at 20? What are we at? 26, 27, 28, something like that. And you have, the potential effect of tariffs on interest rates. So that could, that could buffet bonds a little bit as well. So it's a decent diversification strategy that provides a stable return, a sleep well at night kind of strategy, if you will.
I think the valuation on the S&P overall is a little deceiving, because you have to look at the equal weight. You're looking at mid-teens for a valuation PE. So, but that's another conversation.
Fair enough.
Let me ask you a follow-up on all of this. How do I think about the specific risks in the strategy? I always want to understand what those risks ultimately might be.
Well, most often the risks are regulatory in nature. The key approval is antitrust approval. The other key approvals are foreign approvals. Many companies are international in nature right now. And so you're seeing many companies, because they operate internationally, so you often need Chinese approval, you need European approval. And given the trade talks that are going on, there's a little bit of a give and take with regard to giving approvals, providing approvals, withholding approvals, and it's all part of a negotiation. But we've seen a much higher closing rate in the last year and a half than we've seen in the last several years. So I think that bodes well for the ability of transactions to be successfully completed, which again is what we're dependent upon. The long-term successful completion rate of our investments, believe it or not, is above 95%.
Yeah, I've done these calls with you many times, and I could tell your excitement level is much higher maybe than it was a year or two ago, just because of, as you described, the overall environment. For those of you that have joined the call today, I just want to remind all of you, you have a Q&A function, and within that Q&A function, we would really enjoy being able to engage with each of you, answering your questions. So if you would, I've got my window opened. Please type in whatever questions you might have for any of the panelists, and I will get to them as this conversation evolves. I want to turn my attention to specific opportunities that we might have. And Dave, let's begin with you. Thinking about specific opportunities, kind of walk us through the various sectors and where you're seeing opportunity currently.
Sure. So obviously, Joe, we're credit investors, and our bias has been higher quality. I'd start off with probably the high yield market. Highest credit quality ever. You had the downgrades during the pandemic, $284 billion of downgrades, Ford, Occidental, Kraft Heinz. Spreads right now inside of 300, but very supportive technicals, good fundamentals. As I mentioned before, debt maturities have been extended, earnings are good and lower leverage. The loan market, very attractive coupons, good technicals, and very solid fundamentals. If I look at IG, corporate credit, good way to get duration and quality. Triple Bs, financials, midstream energy is a place we've been participating, especially contracted cash flows like gas processing and pipelines. In the securitized bucket, I would say high quality, short securitized. Really like the residential mortgage market, non-agencies to be specific. Asset-backed securities, subprime auto loans, consumer loans, franchise receivable loans, up in the stack, really good value. CMBS, single asset, single borrower deals, specifically data centers, industrial warehouses, rural office. Then last but not least, Joe, the foreign markets, overweighting IG sovereigns, overweighting high yield versus investment grade, overweighting local currency, and then overweight in Latin America. But all good value, still a very good total return potential.
Is there anywhere specific, Dave, that you're avoiding?
I'd say that one of the concerns I have is $120 billion of commercial real estate coming due in the next 12 months. I call it survive till 26. With rates higher for longer, especially when you look at office and hotel, the ability to refinance those properties. I'll give you a good example. The Landmark building in Hartford, Connecticut, had a mortgage on 122 million. The main tenant, United Healthcare, left. They defaulted, and the building is sold for 22 million. So it'd be very, very cautious with the office market looking forward. So I would just be, we do like commercial real estate. We do focus on specific, as I mentioned, rural office, industrial warehouses, and also data centers. So staying away from office and hotel.
We actually have a question that speaks directly to your answer. And I guess if the interest rate environment were to change, rates would return to moving lower as they were in the fall. Would that change your perspective on how you feel about real estate?
Absolutely. And that's mostly specific property types in the commercial real estate business. Those that had 5-year balloons that, have to refinance in 2026. I called it survive till 25. I think a 1-year extension. So now it's survive till 26, Joe. And exactly right. As rates come down, they'll be able to refinance.
Perfect. Thank you. Young Dave's talking about lower rates, and he mentioned the dollar in that context. Some will argue that it's been the precipitous fall in the dollar. I think we're down close to 10% on the year for the dollar. We had a down day again today, down about 61 basis points. But that has boosted the dollar-based returns of non-US equities. Do you think that weakness is the quote unquote fundamental catalyst driver for non US equities? And where do you see the dollar continuing to go over the course of time? And what would be the correlation or the effect on non US assets?
Yeah, it's certainly been a meaningful driver. And if you look at the history, non-US equities have tended to outperform during periods in which the dollar weakened. And as you mentioned, the dollar depreciated meaningfully this year, but we should remember that the dollar has been on a very strong run for a long time, and we just saw some mean reversion. So maybe it's helpful to give you a historical perspective here.
Sure.
If you look at the dollar index here on this chart, DXY, which is an index representing the value of the dollar relative to a basket of foreign currencies, we can go back all the way to 1973, which was when the index was created after the collapse of the Bretton Woods system. So this index has a history of over 50 years. And at the start, the value of the index was 100. And it has since been moving up and down, driven by different cycles and various factors. But in its 50 plus year history, the value of the index averaged at around 98. So it didn't really deviate much from the beginning value. It did, however, have, as you can see, peaks and troughs, which may be worth highlighting. In over 50 years, the index had exceeded 110, which is one standard deviation above the average, only 3 times. The first time was in the 80s when the dollar appreciated sharply, peaking at around 150, 160, which led to the Plaza Accord. The second time was during the tech bubble, when it was around 120 in 2001. And lastly, in 2022, when the dollar appreciated, driven by the post-COVID rate hikes. And more recently, in January this year, the index had reached 109.9, so very close to 110, having appreciated steadily in the past 15 years since the global financial crisis. So the depreciation of the dollar this year so far came off of a historically high level and just came down to around the long-term historical average level. But as you can see in the chart, when certain factors and narratives change, these things move in long streaks and rarely stop at the average point, neither on the way up or on the way down. And they tend to swing more like a pendulum. And it tends to strengthen in long streaks and followed by long periods of weakness. So, you have to remember that it had a 15-year bull run. And of course, fresh in investors' minds is the most recent wave of the dollar strength. But it's good to have this historical context. I should, mention one thing. This index is based on nominal exchange rate. But if you look at the real exchange rate, which takes into account inflation and therefore offers a bit more of a fundamental view, the dollar is still 10 to 15% above its long-term average.
Is there any reason for you to suspect that the US is moving away from a strong dollar policy?
Well, trade would be one, trade deficit. And you want to have the government seems to want to have a lower interest rate, which will be also a weaker currency, weaker dollar kind of environment. So we'll see.
Okay. I'd just like to remind everyone to please mute your line in respect to all of the attendees on the call. If your line is not muted, please check right now and see that your line is actually muted. Roy Young was talking about overseas markets, the effect of the dollar, and you began briefly to talk a little bit about M&A activity, not just here in the US, but the rest of the world. I'd love to give you an opportunity to kind of expand upon that, if you would, and walk us through some statistics on it.
That's right. We're seeing a pickup not just in intra-US deals, but we're seeing exclusively foreign deals as well as cross-border deals pick up as well. The currency fluctuations that you've discussed make a difference as well. With a weak dollar, foreign currencies make it cheaper for a foreign company to purchase an American company. But nonetheless, there's a big need here for uh, if creations of efficiencies and cost savings. Everything is very, very competitive right now. And just sort of just to kind of get back to the use case, for example, if you'll indulge me for a second,
Sure.
it'll I know our fund falls into the category of alternative investments, and the alternatives provide a differentiated exposure, if you will, a diversification that allows investors to stay invested in funds like Young's and Dave's during periods of drawdowns. So if you have an equity drawdown, I mean, over the past 3 years, even though we're hitting all-time highs right now, if you look back over the past 3 years, there was an equity drawdown of something like 18 or 19%. There was a bond drawdown of 9 or 10%. But over the long haul, those investments are expected to perform very, very well. So it allows investors to be diversified away and minimize the amount of drawdowns that occur during periods like that, during corrections, during recessions, during economic downturns. But nonetheless, this is more like, providing a stable rate of return during periods like that, whereas the equity markets might outperform us in a roaring bull market, but that's okay because they can sleep at night and they can keep their allocation to equities during a bear market.
Makes a lot of sense. The increase in M&A volume,
Hmm.
what's your expectation? Again, I'm just gonna kind of go back to what I heard last week from the financial sector, and I'm sure you and many on the call have read, the rumors surrounding Bank of New York and Northern Trust and all these potential tie-ups.
Right.
But when you're looking at the increase in M&A volume here in the US and then outside of the US, is it isolated to one specific industry or sector? Is it more broad-based? How do I think about that? I think about the rest of the world. I say to myself, gosh, they probably want more technology exposure. So maybe you see more activity there as a result of that. How would you respond?
I'd say it's kind of rotational. You're
Okay.
seeing you're seeing acquisitions lately. Some of them are driven even by the tariff policies. Companies want to have production in the US so they're not bringing products into the US. So if they buy a US producer, then they're not paying tariffs on it. We've seen activity from, Europe, the Middle East, and Asia increase from $440 billion up to $700 billion over the last year and a half. We've seen North America increase from 790 billion to 1.2. Oh, there's a chart. So and you can see the upward trend over the last couple of years. Um, it's going to depend on tax policies, tariff policies, and also the economic environment. Companies if that need to save on production expenses in a declining cost environment may need to combine to create some cost synergies in terms of production. Um, Other companies may be short of supply, so they'll buy a company that can supply them with raw and finished goods. It's
Yeah.
really going to be, it's across the board. I will tell you, I can't pin it down by industry, but to your point, we are seeing a big pickup in financial. I think the banks are among the most splintered category of public traded companies that there are right now. I've heard that there are thousands of small public banks that are being combined.
Yeah, it sounds like it's very idiosyncratic, and I think I know what your answer is going to be when I follow up with this. I feel like I'm pressing you into an answer that doesn't exist. But if you think geographically, are there areas of the world where people want the presence and therefore you have the potential for more M&A there to buy their way in?
I would say it's the U.S., to be honest with you. I mean,
Mhm.
there really is as I mentioned, as a result of the Trump policies that have changed drastically from the Biden administration policies, people want production in the U.S. They want to be able to say made in U.S. They want to say produced in U.S. because that's where the majority of the consumers are for those particular products, and as well, they're not going to have to pay entry fees. So, we're starting to see it. We've seen it. We're over $2 trillion in deal activity uh, trailing 11 months. So it's created a good selection of transactions for us because we kind of sift through and try to invest in the deals that have the highest likelihood of completion.
And unequivocally, you remain confident that the Trump administration and the potential deal environment surrounding the Trump administration is a much more favorable one. And maybe early on in the administration, some of the muted or pause in the increase in activity was just specifically related to tariffs. Am I hearing that correctly?
Yeah, I think that's right. People were just sort of getting their ducks in a row, waiting to see how the policies played out. But I will tell you this also, there is a ton of private equity money on the sidelines as well. And we're seeing a big increase in private equity transactions. As you know, you saw today, there's discussion about 401k money being allowed to invest in private equity. There is so much money on the sidelines you can't believe. And either they're going to be partners in transactions or they're doing their own transactions, or there's often competitive bidding situations. We've seen many deals. You look at Skechers is trading above the deal price right now because people are hoping that somebody else is going to come in. They thought it wasn't being bought for a fair price. We're seeing a lot of that.
Thank you for that, Roy.
Oh,
Young, we have a question here, and the question basically says, what's the long-term outlook for small and mid-cap stocks? From my perspective, mid-cap stocks have performed relatively well in an environment that seems to be dominated by large caps. But as a result of this question, I guess let me ask you, when looking outside of the US, and we know some of the friction as it relates to US small cap stocks, certainly relative to their equity size class peers. Outside of the US, though, how do I think about that small cap opportunity? Because I see the rest of the world as continuing to improve their standard of living. Pick in whatever regard you want to measure it, in energy, healthcare, uh, diet, transportation. I just think technology, it's all improving and getting better. And I think that kind of helps a lot of those small cap companies.
Yeah, absolutely. So I think maybe the question was more related to domestic small cap, but speaking about small cap in general, small cap tends to be inefficient in general. That is true in the US, but it's more so in international space, and even more inefficient in emerging markets. And many small cap companies in the non-US markets do not have sell-side analyst coverage or have very limited coverage, often do not have English disclosure, and sometimes do not have a ton of trading liquidity, making it very difficult for large institutional investors to even consider an investment. So this inefficiency often presents compelling investment opportunities for investors like us that are specifically focused on smaller companies with a longer term view. And also, by investing in small cap, investors really get true international and EM exposure to businesses that are really closely tied to what's going on locally, all the developments that you are mentioning. Whereas when you invest in large cap, you often get companies that generate a big chunk of their revenue from the US. And within emerging markets specifically, if you look at the large cap index, you have companies like TSMC and Samsung that are really more global companies generating cash flow from all over the world and not just EM. But if you look at our small cap portfolios, both domestic, international and emerging market strategies, our portfolio companies generate the vast majority of the revenue locally. And lastly, I will say, investing in small cap offers investors greater diversification benefits. If you think about it, large cap business results in general tend to be more correlated to the overall GDP. For example, a large company like Walmart will find it difficult to outgrow the US GDP because of its already large size, and its business results will be more of a proxy of the overall economy. Small cap companies, on the other hand, are often influenced more by idiosyncratic business or industry drivers, whether that's gaining market share from larger competitors or growing in a niche space by innovation. So these kinds of dynamics in small cap can offer more diversification benefits. And I'm originally from South Korea, and I tell investors that Samsung Electronics used to be a small cap company back in the early 90s. So if you can pick the right stock, you can find the great businesses before it becomes big, you can benefit greatly.
It's interesting because I had a conversation at the beginning of 2025 with an investor, and we were speaking directly about investing in small caps in the United States relative to non-US small caps. And what she said to me was compelling. She said, well, think about it. A small cap company in the United States has to compete with an Nvidia or a Microsoft or a Alphabet or a Meta. And when you say compete, it means the revenue growth, right? The free cash flow generation. Non-US small caps have the advantage of not having that quote unquote behemoth domiciled in their respective geographic region. And that gives non-US small caps a degree of a competitive advantage. I'll ask you to react to that. I don't know if you agree with it, but I found that interesting.
I think that's valid to some extent, but you also do have competition in non-US markets where US companies are present there. For example, in China, you have Nike there. So Chinese small, clothing brands will have to compete with Nike as well. But it's interesting. It depends on the sector, it depends on the company. So you have to have an active manager who can really pick the winners because, you know, uh, American brands always doing well and winning is just not the case anymore. You just look at the EV industry in China. Chinese local brands are dominating, whereas US brands are struggling. And it's also happening, that kind of a trend is also happening in the alcoholic beverage space. So, but it's really dependent upon the industry and the sector, and you have to really be careful and make sure that you pick the winners.
Okay. Dave, I want to turn back to you for a moment and kind of allow you the opportunity to either alleviate some of the fears that I think generally all us know about the market, or maybe in certain instances highlight what the concern should be as we move forward. The first topic would be obviously the staggering amount of debt on the part of the US government. How should everyone on the call be thinking about that as it relates to investing in risk assets?
Yeah, I mean, the amount of debt is definitely a concern. We're still the reserve currency around the world. It becomes a bigger issue when the market gets concerned. If you look at debt to GDP, I believe we were about 123%. I've given the comparisons to some of the EU outliers of Italy and Greece, and then also Japan being the biggest outlier. But I consider us to be the best house in a bad neighborhood is the way I would categorize it. And I did mention that, it's pretty substantial. The amount that we're paying on interest alone is $1 trillion. So something that will become a concern if we see a recession or we see a downturn in the market. And it's impacting long rates, keeping long rates elevated and keep curve steep.
Concerns surrounding supply?
Supply has been easily absorbed. There's a lot of liquidity out there. There's still a lot of money in money markets waiting to enter the market. I haven't seen any mumblings about supply at this point.
Okay.
Plenty of liquidity, yep.
And if I were to tell you the economic growth is going to slow, and that is not the personal opinion of myself, but if I were to kind of walk down that road that some believe is the case, it might be correct. We see economic growth slowing. What happens to credit fundamentals?
If rates start to trend down, and the cost of refinancing the existing debt becomes cheaper, I think that will be a positive. When we're financing our debt with 18-month paper and when we had the lowest rates in history, it's a little scary. We should have looked at some 100-year bonds or some bonds that were further out the curve. I look at fundamentals right now. I think are good. Defaults in high yield are at 1.4%, which is substantially below the long-term average. Loans are right at the long-term average of about 3.7. As we had mentioned before, leveraged finance companies have extended out their debt maturities. So in general, they're in good shape for any type of slowdown or downturn. And it comes to credit selection, Joe. You don't want to buy an index. You want to buy those that are actively managed and research.
Private credit. Feelings towards, as Roy mentioned, seems to be a very strong interest in private credit. How would you characterize the environment?
We have 1.8 trillion of private credit in the market. Trillion is invested, 500 billion waiting to be invested, 300 billion in cash. Seems like there's a lot of money chasing few deals. It's definitely become very, very competitive. This wasn't the mid-tier, weak single B companies that couldn't get financing. One of the best news items I would have is my loan guy, Franco Sino, would walk in my office and say, remember that credit was trading in the 80s? We thought it was going to default. Our good friends at one of the private credit shops just took us out at par. But we love you guys. I think it's changed, though. I think it's become much more competitive. Now they're doing investment grade transactions. It's added a lot of liquidity. It's really helped the defaults in the market. But I think, it's probably not a bad time to be taking some profits in private credit.
So I'm going to ask you this final question, and I'm also going to invite Roy Young and Barry Mandenack, who I know is still on the call, to respond here as well. But it's interesting. I think back over the last 24 months, and the cash yielding equivalent, whatever it was, 4 3/4. And at the time, Dave, you and I used to have multiple conversations about reinvestment risk. Well, here we are, S&P 6,300. It feels like, we're all trying to relax and enjoy the summer, and the market continues to kind of just gallop ahead. That reinvestment risk is so real, right? Dave, I'll ask you first, and then again, Young, Roy, you want to respond, and I'll finish with Barry. How do you think about the reinvestment risk? What do you say to those on the call that are faced with that challenge?
You say, if you look at even investment grade assets in fixed income, you've got a discount dollar price, you've got yields and investment grade, which exceed 5%, securitized, which are, 4.5% to 8%, depending on which category you're in. You get high yield at 7.17, loans at 8%, high yield emerging markets yielding right around 10% with a discount dollar price. That seems like a pretty good entry time. So I'm a dollar cost averager, Joe. I'm not a market timer. Good time to do dollar cost averaging in the fixed income.
Young, Roy, anything you'd like to add?
Yeah, I mean, I think that I love what Dave does. I love what Young does, and it's part of a diversified portfolio. It's summer's here, as you point out. You want to have a diversified portfolio. If you include a sleep well at night fund or a stable strategy as a diversifier, you can go to the beach and come back. And if Dave and Young's strategy has a correction, it'll be back. But in the meantime, you didn't have a big drawdown because you had a diversifying strategy that provides the ability to give you returns in all market environments and sleep well at night. So I love the combination.
Perfect. Young?
I have not much to add. Just stay invested and be diversified.
I appreciate that. I appreciate the comments from all of you. Barry, I'm going to turn the call over to you, but I'm going to ask you if you'd like to respond, how we should all be thinking about the reinvestment risk.
My comment is, at the risk of sounding like I'm talking up the book of the managers on the call here, but I was reading about the CAPE ratio, and the CAPE ratio being at one of its highest, if not highest, levels ever as it relates to the cap-weighted S&P 500. And I think back to the old adage that it's never the wrong time to be properly diversified, but when diversification is least wanted, it's often most needed. And so, for the last 15 years, the S&P cap-weighted has pretty much smoked every asset class, whether it's small caps and mid caps domestically, or whether it's non-US and emerging markets, whether it's fixed income, whether it's alternative investing. You don't really need to be non-correlated when correlating investing has paid off to such a degree. But it's precisely then that you want to tap the brakes and kind of look at what is the right mix. Fixed income, people don't think about diversification as much as they do equities. But Dave's taught us all that, you got to be diversified in terms of credit risk as well as duration risk. And I also feel the same way about active versus differentiated active versus passive. There's a really important time to be looking at that. So, whether it's international equities and emerging market equities versus US, whether it's small and mid versus large, whether it's cap weighted versus equal weighted, whether it's equity versus fixed income, and whether it's highly correlated or low to non-long-term correlation, all of these areas, to me, make so much more sense with a greater sense of urgency to be making sure we're all properly diversified, given the elevated valuations, particularly of large cap-weighted US SPY type stocks. So that would be my conclusion, Joe. Hopefully that's sensible to you.
Perfect answer, Barry. Thank you very much. Gentlemen, I want to thank you for your time on the call today. And Barry, if you would, take us out, please.
Yeah, I just want to thank everybody for attending today's webinar. If you have any additional market commentary or portfolio specific insights that you want to gather from our folks here, please visit our website at virtus.com. If you have any additional questions or would like further information, please don't hesitate to give us a call at 1-800-243-4361. That's 1-800-243-4361. And with that, Joe, Dave, Roy, and Young, I want to thank you all very much for your time and your great thoughts today. Have a great evening.